Good day to you and a warm welcome to this webinar on ARQ, the hyper-intelligent investment engine created by Angel Broking. I'm Vaibhav Agrawal and I head the ARQ division in our company, Angel Broking, one of the largest and most reputed retail broking firms in India. So what is this ARQ all about? Why do we call it the hyper-intelligent investment engine? Most importantly, how can it help you? What can it help you achieve? What is the problem that it is trying to solve that other products in the market currently do not solve? These are some of the questions that I will try to answer in the course of this webinar, and hope to explain to you the true power of this investment product and how it is at the very cutting edge of investment technology. Just to give you a broad overview, ARQ is a holistic wealth management product. So we cover everything right from mutual funds, including debt and equity mutual funds, as well as direct investments in stocks through ARQ. So it can give you a holistic advice on your overall wealth management goals, right? Now let's first get down to the basics. What is equity all about and how it can really help you? As you can see on this slide, amongst all the various asset classes, the financial assets that are available to you as well as the physical assets that are available to you, right from fixed income assets such as fixed deposits in a bank to gold, property, and stocks. As you can see, over the last 15 or so years, on a post-tax basis and after taking all transaction costs as well, the return on the equity asset class has been the highest, close to about 16%. And it is very much linked to the fact that ours is a growing economy. And any economy which in real terms is growing at anywhere between 6 to 8%, and in nominal terms is growing at anywhere between 13 to 14%, the equity asset class can give a similar return to that nominal growth rate, in fact a little above that. So close to 14 to 15% returns is something that equity inherently as an asset class can deliver to you as an investor, right? Now, this is what is the broad potential of equities. You may or may not have heard about this potential in the past. If you have prior experience in equity, in investing in equities as well, a number of people actually come and tell me that although this asset class has given these kind of returns, but we have not really been able to realize those returns within our own portfolio. And why is that? The reason is because the equity market consists of more than 3,000 to 4,000 stocks, each of which have their own potential. And to be able to pick the right stock, or in fact to be even able to pick the right mutual fund scheme out of the hundreds which are available in the market, is not an easy job. And what is the key problem? Well, one of it is emotions. Because equity is an asset class which is tradable, so the daily prices that are quoted on the exchange tend to go up or down a little bit. That is just the near-term volatility that one sees in this asset class. If one is a long-term investor, over a period of time, it always gives you that, appreciation, that I talked about. But those near-term volatilities is where a number of inexperienced investors tend to trip up. When the market is going up, up and up, greed as an emotion often takes us over and we end up investing at the high point of the market. And when the market is falling, which is when actually it's getting cheaper, but that's when the noise all around us, the news, the events that are happening are so, scary, or, which kind of spell all sorts of negatives, that we panic and we can end up selling in fear at the wrong time. So these emotions tend to affect us. If we are not disciplined in our investments into equity as an asset class, it can lead to challenges. So that is one problem, that often it's difficult to be disciplined in your equity investments and investing without any emotions letting you get affected. The other big problem is that even if, let's say, you are investing in a disciplined fashion, but that does not take away from the fact that there are thousands of stocks to choose from, and every second there is a huge deluge of information which is coming in, which impacts the markets. That information could be global news, when Brexit happened or when Trump got elected, or it can be India specific news such as when demonetization happened, etc. It can be seasonal, such as when monsoons are good or bad. At the industry level, things are happening, tax rates are changing, or some or the other regulation is announced, or the sector is going into a cyclical downturn. And again, then even at the company level, you have so much information coming in. There is a change in management, or a particular product is not doing well, the price of the product is changing. So there is a whole lot of information which is coming in, which is relevant in determining the future returns from that particular stock. And it becomes a challenge even for the best of the experts or the best of the fund managers to be able to analyze this huge amount of information in real time and pick the best stock out of thousands, right? So clearly, these are some of the biggest challenges when it comes to realizing the full potential of equity as an asset class. In fact, your objective when you come to an expert advisor such as ourselves is to be able to beat this potential. If equity as an asset class can give you 14 or 15% returns, you should be able to make a little bit more than that, maybe 2 or 4 or 5% more than that. But the reality is that oftentimes a retail investor ends up making much less than the average return on equity. And so ARQ is all about trying to solve these problems and helping you achieve a better return on equity as an asset class and helping you achieve your financial goals sooner in life, right? So let's get down to what ARQ is all about and what are the USPs of ARQ. ARQ has been developed by Angel Broking using two of our strong skill sets. One is research and the other is technology. And both of them have been critical in making ARQ a reality. A whole lot of traditional research is out there in the market, but till you don't combine it with the superior technology that we use in ARQ, you face all those problems that I talked about in regards to the real-time processing of data and finding the right signals to buy the stocks which are going to do the best. Let me give you an example of how technology is the game changer when it comes to investing. And I'll explain this with an example from a different industry. I'll give you the example of IBM Deep Blue. IBM Deep Blue was a supercomputer made by IBM quite a few years back, more than a decade back. What is special about this, supercomputer is that it was the first to beat the world champion in chess at that time, Garry Kasparov, at his own game of chess. And it was a game-changing event because it was the first evidence that a computer can be smarter than the smartest person in that particular domain. How did IBM Deep Blue do that? And I'll explain it very simply. It's not as complicated as it seems. What they did was they took a whole lot of experts who knew how to play chess, and they took a whole lot of scientists and programmers to use that intelligence of those experts and convert it into algorithms. You see, many of us who know how to play chess would know that the rules of how to play chess are not too difficult to understand. The problem is that when you start playing one-on-one with a player like Kasparov, see, a person who is an amateur at playing chess, he can plan his game maybe a move ahead or 2 moves ahead. In terms of, I'll play this move and maybe the opponent plays XYZ moves I may counter it with this move, and so on. You can look into maybe 2-3 moves ahead, because as you try to look ahead in chess, the problem is the possible permutations and combinations just increase very, very, very exponentially. A great player like Kasparov or Anand, what they can do is they can look ahead 10, 15 moves ahead, even more, because of their inherent natural talent, experience, memory, their, experience of, seeing, studying, and playing so many games, and, being able to know how a game will move ahead as it progresses. And that's how they can trap you with a move now, which will get you 15 moves down the line, and, that's how the best players can beat you. But what can a computer do? Once a computer like IBM Deep Blue has been programmed to know how to play chess, it does not need to look 15 moves ahead. It can literally look 50, 100, 200 moves ahead to the end game of every single permutation combination, right? There are millions and millions of combinations, and it can check out all the ways in which the game can play out. It can simulate that and figure out which is the move right now which can win the game. So you see, then it is no longer about judgment or skill, but about evidence and proof and certainty that yes, this is indeed the best move to play. So you see, once you combine the intelligence of humans in terms of how to do a certain thing, and you combine that with the processing power of a computer, you can achieve things, and you can achieve a level of smartness which a single person cannot do, right? Now, if chess is a complicated game, you can only imagine what is more complicated than the world of investing, which is bombarded by not 1 or 2 or 10 possible moves, but millions and millions of news items and other information coming in constantly. So, after IBM Deep Blue sort of, pioneered into the world of artificial intelligence, artificial intelligence has been since then applied to various fields, and obviously the stock market is no different. And now we are bringing that technology into India. So what we do is we take all our advanced research insights, which are critical. You need to know how to pick stocks, just like you need to know how to play chess before you can program a computer. Similarly, you need to know how to pick stocks, how to analyze their fundamentals, how to analyze all kinds of parameters, take information from the macroeconomic data, from the derivatives data, all sorts of price data, and so many things which impact a stock's price and which can help you in identifying a signal or a trigger to buy a stock. More importantly, in the Indian context, is also the fact that for whatever reasons, out of the 3,000 or 4,000 stocks which are listed, there are many which unfortunately have slightly dubious financials, and it is very important to identify and avoid those minefields which exist. Otherwise, you can take a significant loss as well. So identifying the best quality stocks, identifying the best logic which can help in pick stocks is provided by our research insights. We then use advanced algorithms to optimize and figure out the best model, which can actually pick the stocks with the highest predictive power. So the final result of all this is that we end up with models which have proven predictive power to pick stocks. And how do we do that? By extensive backtesting of these models. We simulate these models across the last several years and see the ability of the model to have been able to pick the right stocks at the right time. And based on that objective of finding the optimum model which performs the best, out of millions of possible such models, we finally find that model with the highest predictive power running our advanced algorithms, and that's the model that we make live under ARQ. So that's the kind of power of research and technology that you get with ARQ, right? The best part is that because it is a computer-driven strategy, it is a rule-based strategy, with proven rules which have worked well across the ages in picking stocks. Automatically there is no emotional bias, there is no greed, there is no fear, there is no any other kind of bias which can come and make your investing process irrational or subjective. It is a purely objective model, and which is also very critical, like I said earlier, in making money in the stock markets. All of this, of course, is delivered through our advanced mobile app, so that you literally don't have to take any effort. It is as simple as clicking a few buttons on your mobile app, and the entire power of this investment engine is available at your fingertips. And that's the best part, because we've already made this engine, and because it is run by computers, it's run by algorithms, and delivered through the mobile platform rather than through an expensive branch-driven model or a relationship manager-driven model. As a result of that, our cost of running this amazing product is close to nothing. And as a result of this, we are able to give you this advanced product free of cost. Once you are an angel broking customer, you are entitled to receive ARQ advisory without any extra fees. The same transaction cost or brokerage that you would pay on your own transactions of buying and selling is the same rate that you would pay even on an ARQ recommended stock. So there is no extra fees whatsoever for this advice. Over here, I just thought I would share with you an example of the world's most successful hedge fund. One of the most successful funds in the world. It's not Warren Buffett, as you may think, but in fact, the Renaissance Medallion Fund, which has given more than 40% returns over the last 3 decades. Even Warren Buffett has done about 22-24% returns, and Renaissance has done this using purely a rule-based model. They do it purely through rule-based strategies, and with that, they have generated more profit than any hedge fund in the history of stock markets globally. So let's now get down to how ARQ can specifically help you invest in mutual funds. And before I move on to how ARQ can help you, I want to quickly cover what are the problems currently in finding the good mutual funds to buy. This is an interesting piece of information. Over here, I've given you a list of the 10 best schemes in terms of returns over the last 5 years and the 10 worst schemes. They are all from the equity diversified category. So all these schemes belong to the same category of mutual funds, which is equity diversified schemes. And as you can see, there is a huge difference in performance. Right from the best schemes which have given 14 to 15% returns, within the same category, you've also had schemes which have given hardly 4 or 5% returns. Now, the objective of this slide is not to talk about any particular scheme, but to just bring out the point that just deciding to invest in mutual funds is not enough. It's a great first step, because clearly mutual funds can help you earn more money than a fixed deposit. But once you've decided to invest in mutual funds, it is also very important to pick the right scheme. Otherwise, you may not end up with the kind of returns you were hoping for. One of the ways in which people often pick schemes is, based on the reputation of the scheme in terms of how big it is. So obviously, if a particular scheme is managing a lot of money, people have trusted it with a lot of money, one would be inclined to think that it is a good scheme. It's a well-known big brand maybe. But if you would have applied this logic back in 2013 and picked the 5 schemes which are the largest schemes at that time in terms of the amount of money they had, the reality is that after that, for the next 3 years, their returns were not even in the top 50, which means there were 50 other schemes smaller than them which gave better returns than them. Another way in which people often pick schemes, is by checking the track record of the scheme in the past. If a scheme has given great returns, or if a fund manager has given great returns in the past, one is inclined to think it will continue giving good returns even in the future. One may go to some of the other websites which provide this kind of information, or a ranking of schemes based on their past performance, or a rating of schemes based on their past performance, and buy those schemes. Now over here, what I'm trying to explain is, if you look at the top, those are the 5 schemes which have given the best returns from 2006 to 2011. If in 2011 you would have bought them, over the next 5 years, their returns actually came down. Down below the 5 schemes that I've given are the schemes which actually gave the best returns from 2011 to 2016. But back in 2011, you could not have identified these schemes based on their track record from 2006 to 2011, because during those years, their performance was not that great. What I'm trying to tell you is that past performance, which is the most important criteria which is being used by people currently to pick schemes, is really not a very indicative criteria to tell you whether the future performance will be good or not. And ultimately what you are concerned with is that in future you should get the best returns from the investment you're making, right? And that is what ARQ does. ARQ is the first mutual fund advisory product which says that the schemes that we recommend are those which are likely to do well in the next 1 year and not those schemes which have done well in the past. And in that way, it redefines mutual fund advice, right? Let's look at the actual returns that our models have given in the backtesting, right? I've talked about the technology, etc., but you are interested in the concrete, tangible results, right? So let's see those returns. Here I talk about the performance of our large cap mutual fund model, which recommends 2 large cap mutual fund schemes every month for you to invest in. As you can see, that the schemes recommended by the ARQ large cap mutual fund model gave 8.5% more return every year over the last 7 years as compared to the Sensex, which is the benchmark index for measuring equity returns in our country, right? So if the Sensex had given about 12.5% returns over the last 7 years, ARQ large cap schemes gave you 20% returns post-tax, right? So that's the kind of potential, that's the kind of power that is unleashed to you through something as simple as the ARQ large cap mutual fund model, right? Look at the difference it makes. Over 7 years, if you get that extra 8.5% return, your 1 lakh becomes 3.5 lakhs instead of just 2.3 lakhs. So that's a tangible benefit in your portfolio over a period of time due to the power of compounding. Our Midcap mutual fund model gave 11% more return than the Midcap index. The Midcaps in India, these are the companies which are, slightly in the mid-range compared to the largest companies in the country. And because they are in their high growth phase, there are many Midcaps in India which have the potential to give extremely high returns. And the fund managers of these Midcap funds are ever on the lookout for those best stocks which can give very, very high returns. So the Midcap index itself gave about 19% returns over the last 7 years. The beauty is that the mutual funds recommended by ARQ in the Midcap category were able to generate 27.5% return in the backtesting that we did over the last 7 years. And that's 11% more than the Midcap index. In this slide, I talk about how our large cap and Midcap recommendations not only beat the index, but they also beat the category average of all the mutual funds in their respective categories, right? So not only should you make more money than the market on an average, but you should also be invested in the best scheme so that you get the best performance out of the best schemes available in the market. And that is what the ARQ models have shown the proven ability to do. This here is the actual performance of ARQ recommendations, which went live from November 2015. As you can see that in most of the categories, we are beating the index by a good 5 to 6%. In midcaps, right now, the performance is a little bit lower than the benchmark midcap index, midcap and BSE 500 indices. But if you see, that's partly because mutual funds in general in that category have done a little bit less than the benchmark, and this kind of a thing tends to happen in equities, and that's where I said you need disciplined and patient investing in order to realize the long-term potential of equities and not get too worried about the volatilities. If you can see, ARQ midcap mutual funds were able to beat the category by a good 4%. It's just that that category in general is a little bit below the index right now, but we're quite confident that it'll bounce back as has always been in the past as well. Okay, now With that, let's come down to the stock strategies of ARQ. That is one of the most exciting parts, of the overall ARC product, where we give you advice to invest directly into stocks, the stocks which have the maximum potential to beat the markets. The stock strategies of ARC, I'll just explain to you in short. I have talked about 5 of those strategies in this slide. All these 5 strategies, what we do is we tell you 3 stocks in each strategy. So we give you 3 stocks to invest in, let's say, the large cap model, right? And once you invest in those 3 stocks, every month we let you know what changes you may need to make, if at all. So we monitor your portfolio on a monthly basis because stock markets obviously are dynamic, things change. And so we keep your portfolio fresh with the best stocks, by letting you know every month what you need to do. We also have some diversified models where you can invest in 12 stocks at a time. So if you have a larger portfolio and you're looking for more diversification, we also have a couple of 12 stock strategies, right? Now, let's look at some of these strategies and what makes them special. Out here, I talk about one of our strategies, which is a 3 stock strategy called Fundamental Winners. Now, this strategy uses some of the most insightful research that we have on fundamental, excuse me, on the fundamental side of things. So we analyze the quality of stocks, and the best fundamentally, the best stocks are picked by this model. As you can see, the returns of this model are almost 5 times the index. So far I've been talking about mutual funds which were beating the index by 8% or 9%. With our stock models, we are beating the index by close to 40–50%. Now these are the back-tested results, right? So we do a scientific back-testing, and these are the back-tested results after taking into account your transaction charges such as brokerage, securities transaction tax. All those things are taken into account. Now, don't get me wrong, these are the back-tested results which I'm sharing with you to show the power of these models, in terms of predicting the best stocks over the last 7 years. But always remember, that stock markets is never about getting a guaranteed return. It's all about patient investing, and it's all about getting that little bit of extra return over the index. And even if you're able to do that, even if you're able to get those, 2, 3, or 4, or even 5% more than the index, over a period of time, that makes a huge difference to your portfolio. So while our models have amazing, power to pick stocks, just keep in mind that the objective for you as an investor is every year to make a decent, consistent return over and above what the markets are delivering. Let's look at the value stock strategy. Now that's another, thematic strategy that we have, which uses, some very interesting indicators to help you, identify the cheapest and the best stocks to buy in the market, which can give you great returns in the future. Again, as you can see, that the performance of this model in backtesting was simply phenomenal, at close to a 67% outperformance over the BSE index, BSE 100 index. Okay, now here is one of our 12 stock strategies called the stable stock portfolio. As you can see that the returns of this model are about 3 times the BSE 100, about a 26% outperformance. So why am I talking about it? The reason is that this is an interesting model where we have significantly optimized even on the risk front. This model, when the market tends to have those short-term corrections, corrects less than half the market, and when the market goes up, it gives more than 3 times the returns of the market. So on a risk-adjusted basis, this model is able to give you a significantly better experience when you're investing in the markets, because it tends to reduce your volatility, those things which, really create those emotions in the short term, those negative emotions when the market tends to come down at times. It's difficult to face that. Although we know from our learnings that eventually it will go up again. But when it's happening, it's tough. And this model tries to reduce that pain drastically by correcting less when the market corrects and going up more when the market goes up. And this is again to, highlight to you the power of our algorithmic engines, which when we give the objectives to optimize on risk and return, are able to give us models which are able to do both. right? And that's why here I want to talk a little bit more about the power of these models. Very quickly, I'll just try to explain to you what drawdown is. Drawdown is basically the short-term corrections in the market. Now, as you can see, this chart that I've given to you is about the Sensex. And as you can see over the last, the period that I've captured over here from 2010 to 2013, there were periods when the market did correct quite a bit. And you should be aware of that. The market saw a correction of about 28% in round about 2011. The Midcap index had an even bigger correction. But what about ARQ? ARQ corrected only 19% during this period, so it was less than a half the correction of the markets. How about other mutual funds? So mutual funds, large mutual funds with a big diversified portfolios also saw a big correction, because obviously when the market comes down, the funds which have invested in the broader markets also tend to come down. You look at mid-cap mutual fund schemes, they did see a 30% correction as well. The point is that even though they see the short-term corrections, eventually in the longer term, they do give phenomenal returns, much above fixed deposits, much above property, much above gold. But even in the short term, it is important to reduce that risk, and that is what ARQ does. Let's look at another parameter. This is something which the mutual fund industry often reports, which is the SHARPE ratio. Now, what is it? Now, let's not get into too much of jargon. I'll just explain to you in very simple terms that SHARPE ratio is simply the risk-adjusted return, or the amount of return that you make in relation to the amount of risk that you take. And the ideal scenario is that you should get more return with less risk. And when you get more return for less risk, your SHARPE ratio will be higher. Now, Sensex, had a SHARPE ratio of 0.48. The Midcap index gave a SHARPE ratio of 0.76, so it gave more returns for the level of risk that you took. What about ARQ? ARQ had a SHARPE ratio of 2.43. And in simple terms, what does that mean? For the amount of risk that you took in ARQ stocks, it gave 5 times better return than what the Sensex was able to give. So the risk-adjusted returns were 5 times better than the Sensex. So you can only imagine, when you look at even the mutual fund industry has been able to give a SHARPE ratio of around 0.6 to 1 time, but ARQ is able to give almost a 2.5 times SHARPE ratio, which is way, way better than any of the other investment products which are available out there. And that shows the power of, using rule-based algorithms, something which globally is being used increasingly, whether you look at the US or Europe or Japan, and now we're bringing this to India to help you realize the full power of, these rule-based engines, which have been able to outperform fund managers in many global markets, and which are now doing so even in India. This is the actual performance of ARQ stocks since we launched it. The ARQ index is something that we've created, which actually captures the average performance of all the various stock strategies that I talked about. We launched it in 12th May 2016, and about a year has passed. And during this time, investors have, and this is the actual results of investors investing into ARQ. 100 rupees invested in ARQ has given close to 40% return, while the index gave about 20% return. So in real world scenario, we're talking about a 20% better performance than the index. And in absolute terms, close to a 40% return on your investment in ARQ stock strategies, right? So that is the kind of tangible performance that I'm talking about. It's not just all about talking about algorithms and technologies and such things. Definitely that is the power which gives the confidence to invest in ARQ, that it's being run by an intelligent engine far superior to, even what investment experts are able to do on their own individually, right? And the real result of that performance is right in front of you, right? As you can see, there are individual strategies which in a 5 or 6 month period have given 20-30% more returns. So these are strategies launched at different periods of time, and you can study this presentation in more detail as well, once the webinar is over. But yeah, I mean, the fact is that each of our strategies are giving tremendous returns. With that, I'll quickly move to the last part of this webinar, how you can actually start investing in ARQ. So when we launched this engine, one of the things was obviously to be able to give you the full performance, the full power of the Indian stock markets at your fingertips. But it was not just enough to give you great performance. In this digital age that we are living in, one of our core objectives was also to be able to give you this performance in the most convenient fashion through a mobile app, so that you would have no effort at all in investing in this product, right? And the other most important aspect, for those people who have invested in the past, they would know that every time they get advice or a tip, on which stock to invest in, it's very difficult to get follow-up advice. You have to go back to the person who gave you the advice, ask him what you should do, whether you should sell, whether you should buy more, whether you should continue holding. It's a big hassle. And often what happens is, due to inertia, your portfolio ends up stagnating with stocks and mutual funds, which were great some time back, but which are no longer that great. But with ARQ, you get constant automatic advice automatically pushed to you, so that you are never left with a portfolio which is stagnant. You always have a fresh portfolio of the best stocks, and that too without any effort whatsoever. How does it work? So if you're not an angel broking customer yet, it's as easy as filling up a form on our website, and in less than an hour you will have an account open. In fact, soon we would be moving to pretty much instant account opening using Aadhaar and PAN card identification. But it's as simple as opening your account online, and very quickly you just need to download our mobile app and start investing. Now out here on this slide, what you can see is the screenshot of our mobile app menu. And as you can see, the third item itself very prominently is ARQ Advisory. And so these are a few of the things which are there in ARQ Advisory. I talked about stocks, I talked about mutual funds. There are a few other things. You can even check the portfolio, your own portfolio's health, how it is right now, using the health check feature. And of course, you can track your portfolio through that ARQ portfolio item as well, so that you always know how your investments are performing. The first item is Experience ARQ, which I'll just very quickly talk about towards the end of the presentation as well. So right here, is the screen which comes when you click on mutual funds. It's very simple. You just need to say whether you're looking for tax saving schemes or fixed income schemes or equity schemes, and what is your risk return preference. And in the next screen, it will show you which are the two schemes within which are perfect for you to invest in. All you have to do is click on the Invest Now button, and your investment can start. So it's as easy as that. If you want, you can even create an SIP of these schemes. There is an online process right now, but there is also an offline process if that's more convenient for you as regards your bank ECS mandates. But increasingly we are moving towards the direct online platforms as well. So that said, so that's how easy the mutual fund investing is. The top two schemes which will give you the best returns over the next 1 year, available at your fingertips within hardly a couple of clicks, right? Now let's look at Experience ARQ. So one of the things that we've also covered, which is a very significant part of what ARQ is able to do for you, is not just tell you which stock to buy or which mutual fund to buy, but give you overall wealth management advice. What you also need to know from a wealth management perspective, first of all, is how much you should put in equities, how much of your wealth should be in fixed income interest earning assets, how much should be in gold, right? And for that, we've created an advanced robo-advisory product. All you have to do is answer a few questions like this: how old you are, what are your investment objectives, your investment horizon, and your experience so far in investing. And it will very quickly tell you what is your risk profile, whether it is low or whether it is high. And it will tell you based on your preferences of risk and return and your ability to take risk as well as your willingness to take risk and get return, how much you should put in equity, how much you should put in debt, and how much you should put in gold, right? You press invest now and you get a screen which tells you within each asset class, whether it be equity or fixed income or gold, which is the best stock or scheme to select based on the advanced predictive models that I have so far described to you, right? So we are telling you how much to invest in each asset class, and also which stock or scheme within that asset class will give the best returns over the next 1 year, so that you get a holistic advice to manage your wealth on a continuous basis and compound your portfolio, right? How do we give the asset allocation between equity, gold, and debt? We use something called the modern portfolio theory, which is quite literally, one of the most advanced and well accepted and reputed frameworks for giving asset allocation advice around the world right now. Whether you look at the US or Europe, you will find that modern portfolio theory is the most reputed, and for good reason. It is in fact a Nobel-prize winning framework, for understanding a person's risk profile and giving him the optimum amount of investments in equity, fixed income, and gold, so that you get the lowest risk in your portfolio and the highest possible return, right? So it is able to maximize your returns for your level of risk. Over here, what I've given are the screenshots on our mobile app for investing in our stock strategies. Again, it's very simple. On the first screen, we just ask you whether you're looking for the 3 stock strategies, or whether you want a more diversified 12 stock portfolio. And again, we ask you for your risk return preferences. I should just mention that the minimum investment amount for 3 stock strategies is 25,000 rupees, and it is 1 lakh for the 12 stock strategies. For mutual funds, it's as less as 10,000 rupees if you're doing a lump sum investment, and as less as just about 2,000 rupees if you're doing an SIP investment. So it varies, depending on the nuances of what you're investing in. So let's say you specify how much you're looking to invest and what are your preferred level of diversification. On the next screen, we simply tell you what is the right strategy for you, whether it's the fundamental winners or value stocks or large cap stocks or mid cap stocks. Within that, which are the 3 best stocks to invest right now. All you got to do is invest now, and those stocks will be in your portfolio right away. And after that, and that's another revolution that we're bringing in with ARQ, which you will not find in the market right now, which is that once you start a particular strategy, once you get those 3 stocks in your portfolio, they're constantly monitored. And even if you buy multiple strategies over a period of time, you keep investing more money at various points of time, you don't have to monitor those portfolios individually, separately, every now and then. It all gets synchronized for you, right? So that just once in a month, you have to come to the ARQ portfolio, check out how it's doing, just press a single button, and straight away, whatever changes you need to make in any of your strategies, any of your portfolios, is done within a single click. Whatever stocks have to be sold, whatever stocks have to be bought, all of it is with just 1 click. You don't have to place separate orders whatsoever. Just once in a month, just all you have to do is spend 10 seconds in a month, and you get the full power of ARQ at your fingertips on a constant basis with all the latest investments, so that your portfolio never goes stagnant, and that too just with 1 click once a month. That's all it takes. You literally become your own fund manager with multiple portfolios, but there is no fees, there is no AMC charges what a mutual fund will typically charge you, and there is no hassle whatsoever, right? So it's and this is how it looks. You just come to your ARQ portfolio. The first screen is when you click on your portfolio, ARQ portfolio button, you get to see all your strategies, right? You may have invested in 5-6 strategies, as you can see on this screen. Let's say fundamental winners, mid-cap stocks, quality stocks. Let's say you got all of them over a period of time. As you can see down below, there is a button called rebalance. just once a month you have to come and click on that. We will send you a notification when you have to do that as well. You don't have to worry about that on your own. We will send you a notification. You click on the notification, land on this page, click on rebalance. You will get a list of stocks to sell and a list of stocks to buy, which is pre-populated over there with the right quantities, right prices. You just have to click on submit, one single button, submit. All the orders are placed and your portfolio is refreshed with all the latest advice, right? So that's how it works. You know, it's as simple as a click a month, and you get the power of this most advanced stock investing product, which is available in the Indian markets right now. You know, with that, I'll come to a close for my presentation. If there are any questions that you have, any feedback that you want to share, any queries that you have, just drop us an email at webinars@angelbroking.com and we will revert to you ASAP. Right, so just please feel free to get in touch with us for any queries that you have. And with that, happy investing and thank you so much for listening.